Here is the thing nobody puts in the beginner investing guides. Not investing is not a neutral choice. It is a decision to lose purchasing power, slowly, on a schedule set by the Federal Reserve. At 3.5% annual inflation, the historical average over the past decade, $1,000 sitting in a checking account is worth about $700 in today's purchasing power 10 years from now. The number does not change. The math does. The average U.S. checking account paid 0.08% in annual interest in 2024. Inflation ran at roughly 3.5% over the same period. That 4-point gap is what economists call a real negative return. Your balance goes up by $8 per year on a $10,000 deposit. The cost of everything you buy goes up by $350. High-yield savings accounts temporarily close that gap during the Federal Reserve's rate hiking cycle, reaching 4 to 5% in 2023. Rates are falling again. Savings accounts are not an investment strategy. They are a waiting room with a coupon. The mechanism that compounds wealth over time is not a savings account. It is the ownership of productive assets, and specifically, the ownership of a diversified slice of the American economy. Most beginners want to pick stocks. This instinct is understandable and almost universally wrong. The SPIVA report, published annually by S&P Global, tracks how professional fund managers perform against simple index benchmarks. Over any 15-year horizon, approximately 92% of actively managed U.S. large-cap funds underperform the S&P 500. Not underperform slightly, underperform materially. Net of fees. The people whose entire job is to beat the market lose to a passive index fund more than 9 times out of 10. Warren Buffett settled this empirically in 2007. He placed a $1 million bet that a single S&P 500 index fund would outperform a curated basket of hedge funds over the following 10 years. He won by a margin that was not close. The hedge funds returned 42.3%. The index fund returned 85.4%. The professional, sophisticated, expensive approach did not just lose, it lost by half. The logic is structural. An S&P 500 index fund gives you fractional ownership in 500 of the largest American companies simultaneously. When you buy it, you own a piece of Apple, Microsoft, Nvidia, JP Morgan, and every other dominant company in the economy. When one fails, the others absorb the weight. When the economy grows, your share grows with it. The hidden variable most beginners underestimate is the expense ratio, the annual fee the fund charges. A fund charging 1% annually versus 0.03% sounds trivial. On $100,000 at 7% returns compounded over 30 years, that 1% fee costs you approximately $80,000 in final portfolio value. The cheapest S&P 500 ETFs available today charge about 3 cents per $100 invested per year. Before you open a brokerage account, 2 conditions have to be true. First, no high-interest debt. If you carry a credit card balance at 22% APR and invest simultaneously in the stock market at an expected 8% return, you are paying 14 net percentage points per year to hold that debt. A $10,000 credit card balance at 22% costs $2,200 per year in interest. Eliminating it is the financial equivalent of an investment returning 22% with no loss of principal, a rate that simply does not exist in any legitimate market on Earth. Second, a 3 to 6 month emergency fund. Markets fall. In 2008, the S&P 500 declined 48% from peak to trough. In March 2020, it dropped 34% in 33 days. An investor without a cash cushion who faces a job loss or an unexpected expense in those environments is forced to sell at the exact moment when selling destroys the most wealth. The emergency fund is not optional. It is what keeps a temporary paper loss from becoming a permanent one. Here is the single most important data point in investing. A study of S&P 500 returns from 2003 to 2023 found that an investor who stayed fully invested earned an annualized return of 10.2%. An investor who missed just the 10 best trading days during that same 20-year period earned 4.5%, missing 30 days, less than 1%. The 10 best days in 20 years tend to occur within 2 weeks of the 10 worst days. You cannot time the market by moving to cash and jumping back in when it feels safe. By the time it feels safe, the recovery has already happened. An investor who bought the S&P 500 inches October 2007, the peak before the worst financial crisis in a generation, watched their portfolio fall 48% over the next 17 months. By early 2013, they had broken even. By 2015, they were up 40%. By 2024, they had roughly quadrupled their initial investment. The investor who sold in February 2009 locked in a 48% loss and missed the entire recovery. Compound growth is not a metaphor. It is arithmetic. A portfolio growing at 8% annually doubles in approximately 9 years. One that grows at the same rate, but loses 5 years to panic selling, takes 14 years to reach the same destination. The market does not wait. The rules are not complicated. Start early. Buy the index. Eliminate high-interest debt first. Build the emergency fund. And when the market drops, because it will drop repeatedly, on a schedule nobody can predict, hold what you own. Understanding money is your best defense.